Monday, October 19th, 1987. A morning like any other, or so it seemed. The sun rose over the East River, casting long, sharp shadows against the limestone canyons of Wall Street. In the quiet hours before the opening bell, there was no sound of sirens, no smell of smoke, no visible indication that the world's financial architecture was about to buckle. But beneath the surface, in the invisible veins of fiber optic cables and the burgeoning digital consciousness of global commerce, something was beginning to unravel. If you were to look at a chart of that day, it looks like a sheer cliff, a vertical drop into an abyss that defied the laws of economic gravity. On that single day, the Dow Jones Industrial Average plummeted over 500 points, losing nearly 23% of its value in a matter of hours. To put that into a modern perspective, imagine the Dow at 38,000 points, and then imagine it losing 8,500 points between breakfast and dinner. It remains, to this day, the largest one-day percentage drop in the history of the American stock market. This is not just a story of numbers or a dry accounting of lost trillions. It is a story of human hubris, of a blind faith in machines that we didn't fully understand, and of a terrifying day when the adults in the room realized they were no longer in control. It was the day the machines broke the market. To understand how we reached the edge of that cliff, we have to look back at the years that preceded it. The early 1980s were defined by a sense of emergence. The world was finally shaking off the grey, suffocating blanket of the 1970s, a decade defined by stagflation, oil shocks, and a general sense of American decline. By 1982, the mood had shifted. The United States entered what would become a 5-year super bull market. It was an era of profound optimism, fueled by a new prevailing orthodoxy known as the Great Moderation. The man at the center of this was Federal Reserve Chairman Paul Volcker. With a stern, uncompromising hand, Volcker had crushed inflation using punishingly high interest rates. By the mid-80s, the medicine had worked. Inflation was down, growth was up, and the sentiment on the street was that the economic cycle had finally been tamed. The adults were back in charge. The political landscape mirrored this confidence. This was the age of Reaganomics in the United States and Thatcherism in the United Kingdom. It was a time of aggressive deregulation, tax cuts, and the privatization of state-owned industries. The government was stepping back, and the free market was stepping forward as the ultimate arbiter of value. In this environment, Wall Street became the cultural center of the universe. It wasn't just about money anymore. It was about a lifestyle, an identity. This was the era of the movie Wall Street, where the fictional corporate raider Gordon Gekko paced the shores of his beach house, declaring that greed is good. To the young men in power suits and thin ties, that wasn't just a movie line. It was a mission statement. Wealth was seen as a virtue, and the stock market was the altar where that virtue was celebrated. But beneath the champagne-soaked surface of 1987, the foundations were beginning to crack. The primary driver of the concern was a valuation bubble that had become disconnected from reality. Between January and August of 1987 alone, The Dow rose by an incredible 44% in just 7 months. Price-to-earnings ratios, the measure of how much investors are willing to pay for every dollar of a company's profit, had soared to 20. These were levels the world hadn't seen since the summer of 1929, right before the Great Depression began. There were also the twin deficits. The United States was spending far more than it was making, running massive trade and budget deficits. This put immense downward pressure on the US dollar. To manage this, global powers had signed the Louvre Accord in February 1987, an agreement to stabilize currency exchange rates. But by the late summer, that agreement was fraying at the edges. Tensions were rising between the US and West Germany. Germany's Bundesbank, forever wary of inflation, began raising interest rates, a move that infuriated US Treasury Secretary James Baker. At the same time, domestic interest rates were creeping upward. 10-year Treasury yields jumped from 7% to over 10% in the months leading up to October. This meant that the risk-free return of government bonds was looking much more attractive than the volatile world of stocks. Perhaps most significantly, the very structural nature of the market was changing. In the mid-80s, we saw the birth of program trading. For the first time in history, computers were being linked directly to the exchange floors. Decisions that used to be made by human beings in a state of contemplation were now being executed by algorithms in a fraction of a second. Every catastrophe has its cast of characters, some who tried to stop it, others who inadvertently built the engine of destruction. In August of 1987, the legendary Paul Volcker stepped down as chairman of the Federal Reserve. He was succeeded by Alan Greenspan, a man who would later be known as the Maestro. At the time, Greenspan had only been on the job for 2 months. Black Monday would be his baptism by fire, the moment that would define his decades-long career. Then there was James Baker, the U.S. Treasury Secretary. A polished political operator, Baker found himself embroiled in a very public, very high-stakes spat with West Germany over their interest rate hikes. His rhetoric in the days leading up to the crash is often cited as the psychological trigger that pushed the first domino. On the exchange floor, there was John Phelan, the chairman of the New York Stock Exchange. Phelan was a traditionalist presiding over a revolution. As the crisis hit, images of him on the balcony of the exchange, his face etched with a look of sheer bone-deep exhaustion and horror, became the visual shorthand for the collapse. In Chicago, the second city of American finance, Leo Melamed stood as the chairman of the Chicago Mercantile Exchange. Melamed was a pioneer of financial futures, contracts that allowed investors to bet on the future direction of the market. He was a fierce defender of the electronic market, even as the critics began to point their fingers at the computers. And then there were the villains of the era, at least in the eyes of the public. Men like Ivan Boesky, the arbitrageur who was already facing legal ruin for insider trading, had created a culture of merger mania. Corporate raiders were using junk bonds, pioneered by the controversial Michael Milken, to take over venerable American companies. This fueled the stock rise, but it also created a market built on a mountain of debt. Amidst the chaos, Some saw it coming. Paul Tudor Jones, a young, intensely focused hedge fund manager, famously predicted the crash by comparing 1987's charts to those of 1929. In a documentary titled Trader, filmed just before the crash, Jones is seen betting aggressively against the market. While the world lost billions, Jones would walk away from the wreckage with a profit of roughly $100 million. To understand why 1987 was different from 1929, we have to look inside the black box. We have to understand portfolio insurance. It was an ingenious idea on paper, invented by academics Hayne Leland and Mark Rubinstein of the firm Leland O'Brien and Rubinstein. Using the mathematical beauty of the Black-Scholes model, they designed a strategy to limit an investor's downside risk. The logic was simple. If the stock market fell by a certain amount, say 3%, a computer program would automatically sell S&P 500 futures in Chicago. By selling these futures, the investor would offset the losses in the actual stocks they held in New York. It was marketed to big pension funds and institutional investors as a way to have your cake and eat it too. You could stay invested in the bull market, but the moment things turned sour, the insurance would kick in and lock in your gains. But the model had a fatal flaw. It was based on the assumption of a continuous market. It assumed there would always be a buyer on the other side of the trade. It didn't account for what happens when everyone's computer, thousands of them, all programmed with the same logic, tries to sell at the exact same moment. To make matters worse, there was index arbitrage. This was the bridge between the futures market in Chicago and the stock market in New York. Computers were programmed to look for tiny price differences between the two. When portfolio insurance programs started dumping futures in Chicago, it drove the futures price down. Then, the arbitrageurs' computers would see those cheap futures and buy them, while simultaneously selling the actual stocks in New York to hedge their position. This created a feedback loop of staggering power. Stock prices drop. Portfolio insurance sells futures. Futures prices drop. Arbitrageurs sell stocks. Stock prices drop further. It was a death spiral written in code. And finally, there was the dot system. The New York Stock Exchange had recently implemented the designated order turnaround system. It was a modern marvel, meant to handle 200 million shares a day, a massive volume for the time. On Black Monday, it would be hit with over 600 million. The plumbing of Wall Street didn't just leak. It clogged, backed up, and finally burst. The crash didn't happen in a vacuum. The tremors began the week before. On Wednesday, October 14th, the House Ways and Means Committee filed legislation that would eliminate tax breaks for leveraged buyouts. This was a direct hit to the ARBs, the arbitrageurs who had been betting on corporate mergers. That day, the Dow dropped 95 points. At the time, it was the largest point drop in history. On Thursday, the slide continued. Meanwhile, across the Atlantic, nature was preparing its own intervention. A massive weather system, known as the Great Storm of 1987, slammed into London with hurricane-force winds. Trees were uprooted, power lines were severed, and for all intents and purposes, The London Stock Exchange was forced to shut down on Friday. This prevented any kind of coordinated global response as the American markets began to wobble. On Friday, October 16th, the Dow fell another 108 points. It was the first time the market had ever lost more than 100 points in a single day. The weekend was a period of agonizing suspense. On the popular television show Wall Street Week, host Louis Rukeyser tried to project a sense of calm, but the tension was visceral. The final blow came on Sunday morning. Treasury Secretary James Baker appeared on Face the Nation. During the interview, he issued a veiled but sharp threat to West Germany, suggesting that the United States would allow the dollar to slide further if the Germans didn't lower their interest rates. To the traders watching at home, the message was clear. The global agreement to stabilize currencies was dead. The dollar was going to crash, and if the dollar crashed, the stock market was next. When the sun rose on Monday, October 19th, the contagion had already spread. In Tokyo and Hong Kong, markets had already opened and were in free fall. When London opened, despite the storm damage, it immediately dropped 10%. At 9:30 a.m., the opening bell rang at the New York Stock Exchange, but it was a hollow sound. Many of the most important stocks, the blue chips that defined the American economy, didn't even open for trading. There were so many sell orders flooding the system that the specialist traders on the floor could not find any buyers. In the world of the NYSE, you need a buyer and a seller to establish a price. If there are no bids, there is no price. IBM, the absolute bellwether of the era, didn't open for trading for over an hour. Investors were flying blind, unable to even see how much they were losing. By 10:30 a.m., the decoupling occurred. The S&P 500 futures in Chicago were trading at a massive discount, way below the perceived value of the stocks in New York. This was blood in the water for the index arbitrage computers. They began to sell stock in New York with a mechanical, unthinking fury. By noon, the Dow was down 200 points. There was a brief, eerie pause, a quiet period where prices seemed to stabilize. For a few moments, some thought the worst was over. Perhaps the floor had been found. They were wrong. It was merely the eye of the storm. At 2:30 p.m., the death spiral began in earnest. Sensing that the market had no more support, the portfolio insurance programs triggered massive, unconditional sell orders. These weren't orders to sell at a certain price. They were orders to sell at any price. The final 90 minutes of trading were a descent into total anarchy. On the floor of the NYSE, the atmosphere was primal. Traders who had spent their lives in this high-stress environment were seen screaming, weeping, and in some cases literally throwing up into trash cans from the sheer physical toll of the panic. The ticker tape, the digital screen that communicates prices to the world, simply could not keep up. At one point, it fell nearly 2 hours behind. This was the most terrifying aspect of the day. Traders were selling stocks without knowing what the actual price was. It was like driving a car at 100 miles an hour down a winding mountain road with a painted-over windshield. You knew you were moving, and you knew you were in danger, but you had no idea where the edge was until you hit it. When the closing bell finally rang at 4 p.m., a stunned silence fell over the room. The Dow Jones Industrial Average had finished down 508.32 points, a loss of 22.6%. In a single day, the collective wealth of the world had been diminished by $500 billion. While Monday was the day of the crash, Tuesday, October 20th, was arguably the day the world almost ended. It was the day of near death, a moment when the entire banking system began to seize up. The problem was the margin calls. Because of the massive losses on Monday, clearinghouses were demanding billions of dollars from brokerage firms to cover their positions. These firms didn't have that kind of cash on hand. They needed to borrow it from the banks. But the banks were terrified. They saw the volatility, they saw the falling prices, and they didn't know which brokerage firms were still solvent. They began to pull back, refusing to lend. High-profile, venerable firms like Goldman Sachs and Kidder Peabody were reportedly hours away from defaulting. If they fell, the entire interconnected web of global finance would go with them. The turning point came at 8:41 a.m. Alan Greenspan, in a move that would define his legacy, issued a terse, one-sentence statement. The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. It was a simple sentence, but it was a lifeline. Behind the scenes, the Fed flooded the market with cash. They leaned on the heads of the big banks, institutions like Chase and manufacturers Hanover, insisting that they keep credit lines open to Wall Street. By midday on Tuesday, another strange thing happened. At 12:30 p.m., the Chicago Board of Trade's major market index futures unexpectedly surged. It later emerged that a few major players, possibly in a coordinated effort to save the market, bought a small number of contracts to paint the tape and create the illusion of a rally. Whether it was a natural recovery or a manufactured one, the psychological spell was broken. The panic subsided. The system breathed again. In the grand tally of the day, it's easy to focus on the numbers, but the real story of Black Monday is found in the people who lived it. Peter Tuchman, who is today perhaps the most photographed and recognizable trader on the floor of the NYSE, was a young clerk back in 1987. He recalls that the most striking thing about that day wasn't the noise, but the smell. He describes it as the smell of human sweat and adrenaline, a metallic, sour, copper-like scent that filled the cavernous room and stayed in his nostrils for weeks. People were losing their entire lives in the span of an hour, he recalled. It was the smell of a collective nervous breakdown. Then there were the specialists. These were the men whose job it was to maintain an orderly market by buying stocks when no one else would. One specialist, responsible for a major chemical stock, was found leaning against a marble pillar, sobbing. He had exhausted his own capital and then his firm's capital, trying to support the price. By lunchtime, he was $30 million in the hole. He stood there, watching the numbers tick down, realizing that everything he had built, his career, his firm, his reputation, was gone before the sun had even reached its zenith. Away from the mahogany and marble of Wall Street, The pain was felt by ordinary people. Mary G., a 58-year-old widow from a quiet suburb in Illinois, had her entire retirement savings in a mutual fund. On Monday afternoon, as she watched the news in mounting horror, she tried to call her broker. Every time she got through, she was met with a busy signal or placed on a hold that lasted for 40 minutes before the line simply went dead. In a state of panic, she drove to the local Fidelity office. When she arrived, she found a line of 200 people wrapping around the parking lot. She saw elderly people who were physically shaking, some crying openly in the queue. By the time she finally reached a desk, her $200,000 nest egg had shrunk to $150,000. Overcome by fear, she sold everything right there at the bottom. It was a move her adult son would later say vandalized her future, turning a temporary market dip into a permanent, life-altering loss. And then there were the deepest tragedies. While the myths of the 1929 crash often exaggerated the number of people jumping from windows, 1987 saw its own dark shadows. In Miami, Arthur Kane, an investor who had been wiped out by the day's movement, walked into a Merrill Lynch office on Wednesday morning. He was carrying a gun. He opened fire, killing the office manager and wounding another employee before turning the weapon on himself. It was a stark, brutal reminder that while the ticker tape is just light on a screen, the consequences are written in blood. In the wake of the crash, the Reagan administration scrambled for answers. They appointed Nicholas Brady to lead a task force, the Brady Commission, to investigate what had gone wrong. Their verdict was transformative. They concluded that the crash wasn't caused by a fundamental change in the economy. There was no sudden war, no famine, no industrial collapse. Instead, it was a failure of the market mechanism. Specifically, it was the interaction between the stocks in New York and the futures in Chicago, fueled by the mindless algorithms of portfolio insurance. The most famous result of the Brady Commission was the implementation of circuit breakers. They recommended what are essentially speed bumps for the market. If the Dow drops by a certain percentage, trading is automatically halted, first for 15 minutes, then for longer, and finally for the rest of the day. This was the kill switch that didn't exist in 1987. It was designed to give human beings time to take a breath, to think, and to stop the mechanical cascade of a computer-driven panic. The aftermath of Black Monday reshaped the careers of its participants. Alan Greenspan emerged as a legend. His quick action to provide liquidity was credited with preventing a 1929-style depression. This moment cemented his reputation and led to the birth of the Greenspan put, the belief among investors that the Federal Reserve would always step in to bail out the market if things got too bad. It was a belief that would have profound consequences decades later. Portfolio insurance, once the darling of the pension funds, was widely discredited and largely abandoned in its 1987 form. The professors who invented it found themselves the subjects of intense scrutiny, though they defended their models, arguing that the system, not the math, had failed. As for the ARBs and the corporate raiders, their era was coming to a close. Figures like Ivan Boesky and Michael Milken eventually went to prison, though for charges related to insider trading and racketeering rather than the crash itself. The greed is good era was being forced to face a reckoning, even if the appetite for risk never truly went away. One of the most profound legacies of Black Monday was the creation of the Plunge Protection Team. Formerly known as the Working Group on Financial Markets, it was created by executive order in 1988. Its job is to coordinate the government's response to future crashes, to make sure the day of near death on Tuesday never happens again. But for a whole generation of investors, the psychological scar remained. It was the first time the public realized that our new high-tech computer-driven world was actually more fragile, not less. We had built a system of such speed and complexity that it could outrun our ability to control it. While portfolio insurance died, the idea behind it evolved. It gave birth to the modern quantitative hedge fund industry. The belief that math could predict, harness, and control risk survived and flourished. This lineage leads directly to the long-term capital management crisis of 1998, and ultimately to the global financial crisis of 2008. In many ways, the 1987 crash was the alpha of the algorithmic era. When you look at the flash crash of 2010, where the market dropped nearly 1,000 points in minutes before recovering, or the terrifying volatility of the COVID-19 crash in March 2020, you can see the ghost of Black Monday. It was the first time the machines took the wheel and drove us toward the edge. As we look back at the wreckage of 1987, there are strange ironies that emerge. One of the most surprising is that despite the panic, the nothing recession followed. Unlike 1929, the crash of 1987 did not lead to a Great Depression. In fact, the U.S. economy actually grew in 1988. It was a financial-only catastrophe, a fever dream that took place in the banks and on the floors, but didn't quite stop the factories or the shops. Another irony lies in the behavior of the Hong Kong market. They chose to close their exchange for the entire week of October 19th, thinking it would calm the waters. Instead, it had the opposite effect. Because investors couldn't get their money out of Hong Kong, they became even more desperate to sell whatever they could in London and New York. It was a lesson in the dangers of trapping liquidity. There was also the Rolex anomaly. In the weeks following the crash, the resale market for luxury goods in Manhattan collapsed. Not because everyone had lost their money, but because the yuppie status symbols, the Rolex watches, and the Porsche 911s suddenly felt shameful. They were the badges of a culture that had just been humbled. People sold them out of a strange mix of fear and social embarrassment. Perhaps the greatest irony of all is the final tally. Despite the 22.6% drop on that dark Monday, despite the tears on the floor and the panic in the streets, the Dow Jones Industrial Average actually finished the year 1987 up by 2%. If you had gone into a coma on January 1st and woken up on December 31st, and you only looked at the year-end statement for your stocks, you wouldn't have known anything happened. You would have seen a modest, unremarkable year of growth. But for those who were there, for those who saw the ticker tape lagging 2 hours behind reality, it wasn't just another year. It was the end of an era of innocence. It was the day we realized that the markets we built to serve us had become a force of nature, unpredictable, unthinking, and occasionally devastating. The limestone canyons of Wall Street look much the same today as they did in October of 1987. The bells still ring, the tourists still take photos of the charging bull, but the floor is quieter now. The screaming traders have been mostly replaced by the hum of servers in climate-controlled rooms. The machines are still there, faster and more connected than ever. And the lesson of Black Monday remains, a quiet, somber hum underneath the digital noise. The system is only as stable as our belief in it. And sometimes, in the blink of a computer's eye, that belief can vanish. The limestone canyons of Wall Street look much the same today as they did in October of 1987. The bells still ring, the tourists still take photos of the charging bull, but the floor is quieter now. The screaming traders have been mostly replaced by the hum of servers in climate-controlled rooms. The machines are still there, faster and more connected than ever. And the lesson of Black Monday remains, a quiet, somber hum underneath the digital noise. The system is only as stable as our belief in it. And sometimes, in the blink of a computer's eye, that belief can vanish.